What's going on, guys? Welcome back to another video. In this video, I've got another extremely important AMC update to bring all of you this Sunday afternoon. And this information that we're going to be talking about in this video is going to be very important, and you guys all need to really understand what is going on with the information that we're going to discuss in this video going into Monday's trading day. It looks like they are starting to regulate options, and we're going to go over just how important that is. Our situation at the current time, a metaphor that I like to use is that let's say that there is a fire going on in the room, and us as retail investors, by buying and holding more shares of AMC and not having any plans on selling anytime soon, and all of the different regulatory institutions coming out with new proposed rule changes that all seem to benefit us as shareholders of AMC and serve to try and aim to make the market more fair, are essentially just turning off the oxygen in that room slowly and steadily. So that fire is going to represent the hedge funds in this metaphor, and once the oxygen has been fully turned off, that is when we are going to see this squeeze happen. Now, what this proposed rule change that we're going to be talking about in this video is all about, it's options regulation. So let's take a look at the actual options that we have going into next week. So this is going to be the May 28th, 2021 expiration date. And when we look at the option chain, at the current time, there's nothing crazy going on with the open interest. Now, the reason for this is that we're just coming off a monthly expiration date for May. Now, typically on monthly expiration dates, we see a much higher increase in this open interest number over here, which is the amount of contracts that people are holding in their brokerage accounts at the current time. And we also see the volume per day increase as well. Now, coming off that monthly expiration date, we are going to see a slow buildup in all of these different open interest strikes and volume over the next couple of weeks, leading up into this next monthly expiration date on June 18th. And a lot of people have been talking about a couple of these strikes for June 18th. So this $20 strike at the current time has a 34,450 open interest. That is a lot of contracts being held at the $20 strike. But when we come down to the 40, there's 133,587 contracts being held at this strike. Now, I've gone over this a couple of times in my previous AMC videos, but you really have to be careful with trading these super deep out of the money contracts, because if they do not go in the money or you do not sell them at a gain, you're essentially padding the cash balance of all of these different institutions that have sold you these contracts. Now, the fact that there are key differences between the open interest and volume on different weeks for these options contracts is going to be very important once we get over to this new rule change. So we can see here, this document is scheduled to be published in the Federal Register on May 24th, 2021, and available online at federalregister.gov. And they give a link to this right here. And this is essentially what they're talking about. So the exchange proposes to amend options for Section 5, series of options contracts open for trading. The proposal seeks to limit short-term options series intervals between strikes, which are available for quoting and trading on ISE. The text of the proposed rule change is available on the exchange website, this website right here, at the principal office of the exchange and at the commission's public reference room. Now, coming down a little bit further, they do mention a couple of different things here. So the exchange proposes to amend options for Section 5. Specifically, this proposal seeks to limit the intervals between strikes for multiply listed equity options classes within the short-term options series program. Now, what is this short-term options series program? When we come over here, the short-term options series program, weeklies that are a part of the short-term options program have a contract duration term of as many as 5 weeks and are typically listed on Thursdays. These options can expire on any Friday of the month other than the third Friday of the month. Also, short-term options contracts will not be listed for expiration on a date that an existing contract, such as a quarterly option, is set to expire on the same date. Now, when we move back to this document, we are actually made aware of something. The language in this article really does tell us exactly what the purpose of this new rule change is. They don't come out and directly say it, but they do give us a very strong hint. Now, we can see here, by limiting the intervals between strikes in multiply listed equity options, excluding exchange-traded fund shares and ETNs that have an expiration date more than 21 days from the listing date, the proposal does not amend monthly or quarterly quarterly listing rules, nor does it amend the $1 strike price interval program, the 50-cent strike program, the $2.50 strike program, or the $5 strike program. The key thing here, 21 days. So what is going on in this situation is that they are limiting the amount of strikes. Now, why would they want to do this? One, this 21-day really suggests to me that they are trying to really expose all of the failure to delivers in the synthetic shares out on the market. The reason for this is that we've seen a cycle of about 21 days or right around all of the different monthly expiration dates for the options where we see the failure to deliver numbers spike. We can see this happening last month in April, where we come over to this tweet right here and we can see that the failure to deliver numbers massively spiked on this date right here from April 5th to April 6th, but had an even larger spike of about 2 million shares that failed to deliver on April 13th through April 14th. Now, how would limiting these options actually expose these failure to delivers? Now, what the institutions are doing is they are able to hide the failure to delivers by doing some very complicated options trading. There are a couple of ways to do this, so let's explain a couple of them. Now, when we come over to this Reddit post, we've gone over this one a couple of times, but shout out to this individual right here, Lighthouse30130, posting this about a month ago, and this is all going to tie into DTC 2021-005. So if you guys didn't know already, this DTC 005 is probably the most important proposed rule change that we have coming up. Now, we did see this proposed rule change removed from the DTC's website, and we did receive some information that it was only going to be about 2 weeks until this proposed rule change went back up on the website, and they were just tweaking some of the language in it. But it's been about 2 months, I think, or a month and a half since we've actually seen any updates on this. What this rule change is actually proposing is that, say, you have an institution that is lending out shares to a hedge fund. The hedge fund takes those 100 shares, sells them on the open market. Now, when you sell something on any market, you have to have a buyer. So another person buys those shares, and those shares can then be lent out again. So the same shares can be shorted many times over. Now, what DTCC 005 is aiming to do is create a tracking system in order to avoid that happening. That is how the short interest can actually get over 100%. Now, let's take a look at a couple of the ways that the hedge funds can actually make it look like they've covered all of these failure to delivers. Now, a buy right trade, selling a deep in the money call, and buying a synthetic long share from the market maker, or buying a married put, buying an option put with a synthetic share. Now, there's another way for them to do this. They can just buy deep in the money calls, because when you think about this logically, if they have sold shares that they do not own and do not technically exist, if they buy some sort of security or a derivative that guarantees them the right to buy back that security at a lower price, then they technically have an offsetting trade, and this may not show up as a failure to deliver. Now, again, this brings me back to my metaphor. We have DTCC 005 and this new proposed rule change right here that are just sucking the oxygen out of the room and diminishing the flame that the hedge funds have lit. So now when we come over to this website called Option Sonar, this is a very interesting website if you guys want to take a look at it. I'm not affiliated with them in any way, but sometimes when we look at this chart right here, there's nothing crazy going on for this May 20th date. But sometimes I've seen this in the past that these strikes down here in these deep in the money contracts, I've seen this on GameStop a couple of times, automatically or randomly, we'll just see these massive spikes in purchasing of deep in the money calls. One time, we even saw about 70 or $80 million worth of these deep in the money calls purchased. This is what the hedge funds are doing in order to make it look like they have covered a portion of their position or are substantiating their claim to actually buy more shares in order to avoid all of these failure to delivers coming out. So here's what happens. There's a lot of different expiration dates that we have for AMC and GameStop and a lot of these other stocks. And there's a lot of different strikes on these different option chains. By limiting these strikes, the hedge funds are getting a couple of their weapons taken away. And if they want to go in and do these different intricate options trades to actually cover their failure to delivers, or just make it look like they've covered their position in order to avoid any one of these lawsuits that the SEC has started to bring, it's going to be very obvious when they all have to pile into one strike. So this is very important and something to keep a lookout for going into the next couple of weeks once we see all of this volatility kick off. So that is going to conclude this update on AMC. If you guys enjoyed the information and analysis that I provided for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps me out a whole lot in getting this information out to as many people as possible. And if you want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video, so you get to stay up to date on all of your favorite stocks, learn about a couple of new ones, and see exactly which options I am trading and which strategies I am using to trade them. So I hope you guys are having a great weekend, and I'll see you guys in the next video.